We're live at the Congressional Budget Office this morning, where CBO Director Keith Hall will now give us an update on the federal budget and economic outlook for the next 10 years. This is live on C-SPAN.
Well, good morning again. I am Keith Hall, the Director of the Congressional Budget Office. We at CBO have just released an update to our previous budget and economic projections for the next 10 years. I'll briefly summarize those projections, beginning with the budget and then turning to the economy, and I would then be happy to take your questions. So I can get you to my first slide here. There we go. The federal budget deficit for the fiscal year 2015 will be smaller than we projected in March and will decline as a share of gross domestic product relative to last year's. Specifically, we estimate that the deficit for this fiscal year will reach $426 billion, $59 billion less than last year, or 2.4% of GDP, 0.4 percentage point less than last year. This will be the sixth straight year of a declining deficit relative to GDP. However, debt held by the public has grown over the same period and will reach $13.2 trillion, or 74% of GDP by the end of this year. That is slightly less than the ratio last year, but higher than in any other year since 1950. There we go. Over the next 10 years, the outlook does not differ substantially from the one we described in March. Under an assumption that current laws generally remain in place, deficits as a percentage of GDP are estimated to remain below this year's level for the next 3 years, but then begin to rise. In CBO's current baseline, the deficit falls to 2.1% of GDP in 2017, but in the latter half of the decade, deficits average a much higher 3.5% of GDP. Those deficits occur because significant projected growth in spending on health care and retirement programs and rising interest payments on federal debt outpace the projected growth in revenues. By the end of the 10-year projection period in the baseline, rising deficits push debt held by the public up to 77% of GDP, roughly twice the average it has been over the past 5 decades. Under current law, both spending and revenues would remain high relative to historical levels as a share of GDP. Federal outlays are expected to remain near 21% of GDP for the next several years, above the 20.1% that they have averaged over the past 50 years. By 2025, as growth in outlays outstrip growth in the economy, outlays would total 22% of GDP. Spending on 3 components of the budget will grow faster than the economy. The major health care programs, including Medicare, Medicaid, and subsidies for health insurance purchased through exchanges, Social Security, and net interest payments. In contrast, spending in 3 other broad categories, mandatory spending other than that for major health care programs and Social Security, and both defense and non-defense discretionary spending, would shrink markedly relative to the size of the economy. Outlays in those categories taken together would fall to their lowest percentage of GDP since 1940, the earliest year for which comparable data has been reported. Federal revenues as a share of GDP are projected to rise to 18.9% of GDP in 2016, primarily because several provisions of law expired at the end of calendar year 2014. Revenues then are estimated to decline modestly for several years, reaching 18% in 2021, before rising slowly to 18.3% of GDP by 2025, above the 17.4% that they averaged over the past 50 years. The changing pattern in federal revenues as a share of GDP would result from several offsetting movements during all or part of the 10-year projection period. Individual income tax receipts would continue to increase relative to GDP, largely a result of real bracket creep, with smaller effects from recent changes in tax law and other factors. Payroll tax receipts would decline relative to GDP, especially over the next several years, reflecting several factors such as declines to more typical levels in state deposits to unemployment trust funds. Corporate income tax receipts would decline relative to the size of the economy after 2016, mostly because of an anticipated drop in domestic economic profits as a percentage of GDP and the waning effect of recently expired tax provisions. Remittances to the Treasury from the Federal Reserve, which have been very large since 2010 because of changes in the size and composition of the central bank's portfolio, would decline to more typical levels. Beyond 2025, if current laws remained in place, the same pressures that contribute to rising deficits during the next decade would accelerate and push debt up sharply relative to GDP. Such high and rising debt would have serious negative consequences for the nation. When interest rates return to more typical, higher levels, federal spending on interest payments would increase substantially. Because federal borrowing reduces national savings over time, the nation's capital stock would ultimately be smaller, and productivity and total wages would be lower than they would be if debt were smaller. Lawmakers would have less flexibility than otherwise to use tax and spend policies to respond to unexpected changes. And continued growth in the debt might lead investors to doubt the government's willingness to or ability to pay its obligations, which would require the government to pay much higher interest rates on borrowing. For the economic outlook, our budget projections are built on our economic forecast, which anticipates that the economy is expected to grow modestly this year and at a solid pace for the next few years. Although real inflation-adjusted GDP grew weakly early in 2015, the economy now appears to be on firmer ground, and we expect the pace of economic activity to pick up in the second half of the calendar year and over the next few years. After that, we anticipate moderate economic growth constrained by relatively slow growth in the labor force. We project real GDP will grow by 2% this calendar year, by 3.1% in 2016, and by 2.7% in 2017, above its potential or maximum sustainable rate over that period. For 2018 and 2019, we project that the economy will grow at an average annual rate of 2.2%, equal to its potential growth rate. The economic expansion through 2019 will be driven primarily by increases in consumer spending, business investment, and residential investment. Over the next few years, the faster pace of growth and output is expected to reduce the quantity of underused resources, or slack, in the economy. The difference between actual GDP and CBO's estimate of potential GDP was about 3.4% at the end of 2014. CBO expects that gap to narrow to its historical average by the end of 2017. Although labor market conditions continue to improve significantly in the first half of 2015, there is still significant slack in the labor market. Key measures of the remaining slack include the labor force participation rate that remains about 1% below its potential rate, the unemployment rate, which is roughly 1/2 of a percentage point higher than it was at the beginning of the recession, and the share of workers employed part-time who would prefer full-time work, which is about 1 percentage point higher than before the last recession. A direct consequence of persistent slack in the labor market is that wages continue to grow more slowly than they did before the recession. We expect that as slack diminishes, increased competition for fewer available workers will lead firms to begin increasing wages more rapidly in order to attract workers. The unemployment rate remains elevated today. We project that further hiring will reduce it from 5.2% in the fourth quarter of 2015 to 5.0% in the fourth quarter of 2017. Currently, however, most of the labor force slack that can be seen in the low labor force participation rate. We estimate that the current employment shortfall, or the number of people who would be employed if the unemployment rate equaled its rate in December 2007, and if the labor force participation rate equaled its potential rate, is about 2.75 million people. And the elevated unemployment rate accounts for only about 1/4 of that amount. The depressed labor force participation rate accounts for the other 3/4 of the shortfall. Over the next couple of years, faster compensation growth will encourage some people to either stay or enter the labor force, in CBO's estimation. That development will slow the long-term decline in labor force participation, which is attributable both to underlying demographic trends and to federal policies, but it will also slow the fall of the unemployment rate. Over the next few years, reduced slack in the economy will put upward pressure on inflation and interest rates. Nevertheless, CBO expects the rate of inflation, as measured by the price index for personal consumption expenditures, to stay below the Federal Reserve's goal of 2% through mid-2017. an outcome that is consistent with some remaining but diminishing slack in the economy and with widely held expectations for low and stable inflation. And CBO anticipates that the interest rate on 3-month Treasury bills, which has been near zero since the end of 2009, will begin increasing in the fourth quarter of 2015 and rise to 3.4% by the end of 2019. The rate on 10-year Treasury notes, CBO expects, will rise from an average of 2.5% in the fourth quarter of 2015 to 4.2% by the end of 2019. Those rates rise with the anticipated increase in the federal funds rate and expectations of continued improvement in economic conditions. We're now happy to take questions, and before you ask a question, if you could state your name and your news organization.
Alan Framley, could we readdress how do you account for the $60 billion or so drop in the deficit beyond the fact that revenue is higher than, why is revenue higher than you thought it was back in the spring? And you can also explain the slight difference of a few weeks in your projection on when Treasury will run out of room for extraordinary measures, the difference between now and what you said earlier.
Sure. Yeah, those are obviously related questions. The tax revenues so far this year have been higher than anticipated, and we now forecast about an extra $70 billion in tax revenues this year. And the slower economic growth is going to take away, we expect about $10 billion in revenue, so we get that net increase of revenues of about $60 billion.
Why?
Well, with the tax revenues, the question is we don't know. It's why I sort of call it a technical adjustment. It's not because of the slower growth. It's just because tax revenues seem to be higher. And that's actually the reason why we changed our date for when the Treasury runs out of money. As you know, the deficit limit was hit in March, and Treasury's now using extraordinary measures to continue to operate. And this higher forecast of revenues, in our estimation, is pushed back when they run out of money till between mid-November and early December. Yes.
David Lauder with Reuters. Just following on to that question, the components of the revenue increase. Can you talk a little bit about where that's coming from? Is the increase coming from the corporate side, individuals, withheld, non-withheld?
It's actually both from individual income taxes and from corporate income taxes. So both are higher than expected.
Jonathan Nicholson with Bloomberg BNA. These forecasts were locked in July 7th. Can you just give us your take? In the recent days, we've seen the financial markets, the stock markets particularly, go through some troubles. To what extent, in the event since July 7th, where would you shade the forecast now, and how would it affect what you have on paper here, I guess?
Sure. Economic growth looks a little bit stronger since July 7th than we thought, and that would lead us, if we were to change things, we'd probably have a little bit stronger economic growth for this year, but then a little bit weaker for the next 2 years. And with respect to the stock market, I'm not sure we would change anything yet. Fluctuations in equity markets are fairly common. They affect wealth. I think something like $1 trillion worth of wealth has been lost, at least up till yesterday. But that doesn't typically translate right away into changed behavior by either consumers or businesses.
How much should people be worried about seeing those kind of gyrations at this point?
Well, the fact that it happens, and the fact that there doesn't seem to be typically reaction in how people consume or business operate, leads me to think that it's still okay. Economic fundamentals, at least so far, haven't been changed, so I don't feel too worried about it. Yeah.
Steve Cooper with Tax Notes. The report makes the comment that tax revenues are lower because of the expired tax provisions that didn't get renewed at the end of last year. As you know, Congress is beginning to think about extending those provisions again. Can you make the case that by passing and you've done it here several times, that the Section 179 business expensing, if that is renewed, it will bring the debt ceiling limit closer, because Congress will be spending money, and therefore the limit will become closer than it is in mid-November and December that you've estimated.
Well, that's right. We assume that the expiring provision won't be renewed, and obviously, if it is renewed, that will have an effect on revenues in the short term.
And that revenue will break the debt limit ceiling sooner?
I'm not sure. I'm not sure, to be honest. We'd have to sit down and do the I hate to guess, but yes.
Dr. Hall, Paul Krozak, CQ roll call. Federal health care spending has been growing faster than the economy, of course. Did you see any differences in that trend? Did you see a faster rate of growth of federal health care spending, or do you see it slowing down at all? Any changes?
Yeah, no, certainly not since March. I mean, there's been talk about premiums going up, perhaps, but we don't actually have data on that yet. We'll probably have some information on that by the end of the year, so get an idea of whether or not we want to adjust our forecast on premiums. We expect premiums to rise anyway, and this sort of take-up rate in the exchanges is always a big unknown, I think, in our forecast, because obviously we haven't had experience with that yet.
Just looking at, to follow up, looking at the larger picture, there has been over the past several years a slowing in the growth rate of federal health care spending. And the question is, will that continue, or will the growth rate return to a faster pace?
Right.
Do you have any better sense where that growth rate is headed at this point?
Well, it's certainly part of our forecast that spending on healthcare is going to increase significantly going forward. It's been a long-term trend, and of course, then the effect of the subsidies are obviously a big unknown in the exchanges. But we do expect that as part of our forecast that healthcare spending is going to continue to rise. Yes.
If I could just follow on that, Alan.
Sure.
Any of the differences in your projections between now and March traceable to the healthcare law?
No, I think that's pretty close to the same right now.
Nick Timmeros, the Wall Street Journal. I wanted to ask, on your revision of the increase in potential labor force participation, what drove you guys to make that change? Has there been any interplay from the Affordable Care Act on your projections of labor force participation? And how would the change in your projection, could it inform any of our thinking about slower than expected wage gains so far over the past 18 months or so?
Well, I think our notion of a slightly higher labor force participation, the potential there, in part really comes from the pattern. We're actually finding people who are returning to the labor force a little bit faster than we would have anticipated. So it makes us think that the cyclical impact on the labor force was bigger than we thought before. That's been the main reason. I don't know that we've seen any impact on the labor force participation from the ACA so far. It's really hard to know how much that's going to affect things. Certainly, we're going to keep monitoring it and get an idea of what the impact could be. One of the big issues right now, I guess, is the employer mandate is only sort of partially kicked in at this point by this year, and then we've got more of it to kick in later, so we'll have to see what sort of impact that has.
On interest rates, in your changes from the March baseline, you mentioned something like a $300 billion plus downgrade in the amount of net interest payments. Can you explain kind of like, is that why that is? Because I thought you guys had already sort of made a decision on assuming lower than historic rates previously, and kind of what is the new information or whatever, or if that's just a regular fluctuation between forecasts. And then how does that play into this larger debate over the idea that our interest will become such a big burden that we'll have trouble, in 5 or 10 or 20 or 30 years paying our continued interest?
Well, the change in our interest rate forecast really came from looking at financial markets and expectations in financial markets. They clearly were beginning to expect a little lower growth in interest rates than we'd forecast, so we made an adjustment for that. But we still anticipate a real rise in interest rates, really significant rise in interest rates. In fact, the picture's still up there. And almost certainly, if we under current law, we'll have a very large increase in interest payments as these interest rates go up. It's you can adjust it a little bit, but it's still going to be a very large increase in the cost of interest on the debt.
On the interest rate question, or related, I guess, two things. One was there was a line in there about no expectation for a COLA for Social Security recipients this year.
Right.
Can you explain how that is, and I guess what that says about inflation? And along similar lines with Social Security, do you have any new data on disability insurance and when that will be exhausted in your baseline estimates?
Right. Yeah, the COLA on Social Security is set by law to follow the Consumer Price Index. And I forget exactly, I think it's something like it's a pretty significant time period, 1 or 2 year change. And the way it looks right now, that there's just not going to be much inflation on the CPI to give a cost of living index on Social Security. That's what I anticipate. And the other part, I'm sorry.
DI.
Disability
insurance. Any new
timeline
for its exhaustion?
Yeah, no, I don't think we have a new bottom line. I think I don't recall what the exhaustion was last time. I think we talked about it in our long-term budget outlook, but I don't recall.
I'll try again.
Okay.
If they haven't already, Democrats will probably use this report to argue, look, deficit's coming down in the near term, no need to cut spending. Republicans will argue, look at the long term, we need to do something about it. Who's right?
Well, this doesn't change our long-term projection or even our 10-year projection really very much. The pattern's very much like it was in March, very much like it was in January. Under current law, the debt, the growth in debt is not sustainable. At some point, it's going to get to a very high level. Obviously, you can't predict tipping points, but at some point, this becomes a problem. And the way it's going, it's not only just that the debt gets to a high level. I think in our projection, it gets up to 77% of GDP by 2025, but there's also the trend. That's 77% and growing. And that factors into things as well. So this really is, I would still say, this is an unsustainable path here for the federal debt.
Steve Cooper with Tax Notes. Does the report take into account any kind of macroeconomic boost from cutting taxes? In other words, have you used dynamic scoring to show that by cutting taxes, revenues wouldn't be quite as low as previously suggested?
Implicitly, there's a dynamic analysis in this work all the time. Actually, it's sort of nothing new that we have an economic forecast that relies on current law, whatever the tax rates are, and of course part of this forecast is part of this is the growing debt probably has some effect on crowding out investment going forward and slows economic growth.
Speaking of dynamic, since you brought it up, you guys just recently issued your first dynamic estimate of a particular bill, the extenders, back in early August. I was wondering if you can give me some sort of aspects of how that decision was made on the formatting in terms of the tables and so on, and also how much of that was made in discussion with the budget committees, particularly the Senate Budget Committee.
Well, they certainly requested the estimate, and I believe it was large enough for the automatic dynamic analysis to kick in, and we did that analysis along with JCT. Part of what we're learning is the sort of how to effectively communicate the impact. So we did our analysis. I think on that particular thing, that particular Tax Relief Extension Act of 2015, I think it was, we estimated they would increase deficits by about $87 billion over a 10-year period. And we also estimated and put in the estimate that without the macroeconomic feedbacks, it would have been about $97 billion. So you have a nice breakout where you can see where the macroeconomic effects are.
In terms of the formatting, that was all you guys' discussion or decision here, or made in consultation with SBC, or?
Oh, it was our decision. Obviously we've been directed to do the macroeconomic estimate, but we also anticipate that it's going to improve the quality of our estimates to be able to include that. It is a reasonable sort of trade-off. There was perhaps an issue of our estimates not being centered without having the macroeconomic effects included. But it is probably true that it adds some uncertainty to the estimate, which is always uncertain anyway in terms of forecasting the effects. So we're kind of used to the idea of uncertainty in our macro forecasts.
Just to follow up, could you elaborate on, you mentioned centered. Could
Yes.
you go over that issue again?
Well, sure. The Tax Relief Extension Act is a good example. The fact that without the macroeconomic effects, the estimate was about increase in deficits by about $97 billion, but you expect that the lowering of the tax rate is going to have some sort of macroeconomic effect, reducing a little crowding out and such, and so we anticipate it'll increase deficits by less than that, by about $87 billion. So we had this sort of shift of about $10 billion to our point estimate for the impact, if that makes sense.
How much of a challenge has it been to, it's easier probably to do a range of dynamic effect, you estimate a range of the dynamic impact of legislation as opposed to a single number.
Right.
Has it been a challenge, or has it been an issue to do a single number rather than a range?
In my mind, it really hasn't been, because we're asked for a point estimate. We're asked for our best estimate. We could put a range around estimates without macro effects, just like we can with one with a macro effect. So I think we're doing our job to give a point estimate. This is our best estimate. But it is true that is probably more of a challenge to communicate the uncertainty in that, the range aspect of it. We can at least do that qualitatively. It's really hard to do it numerically, to estimate.
What was your reaction to the actual number you came up with? Was it what you expected, or was it more than you expected?
I think it's pretty much what we expected. I didn't sit down and try to predict it, but we've been using the macroeconomic effects and estimates for a while now. We've kind of got the models down, so we kind of have a feel for what the estimates are going to be like. One of the things I anticipate, though, going forward is as we continue to use these estimates and continue to try to be transparent on the modeling and the parameters, that we can get some more discussion about how we do the estimates, and maybe we can improve that over time.
How much more uncertain is on the tax extender bill?
Right.
How much more uncertain is the dynamic score, $87 billion, than the standard score of $97 billion? Because
Right.
if we hear the dynamic scoring that the score is less certain, this is only a $10 billion difference.
Right.
What would your thought be?
Yeah, but one of the difficulties with the macroeconomic effects, and really almost any of our estimates, is there's a lot of unknowns there. So we don't know how accurate it is. We don't know what the range is. When we do our forecasts, especially something like the long-run forecast, we'll vary parameter values to give you a feel for the accuracy. But that's not really a statistical estimate. That's not really a statistical standard error or something like that. So I think we don't have a good notion at this point, and I'm hoping over time we'll get a better notion of that and maybe be able to start communicating that a bit better going forward, is what we think the likely range will be.
So do tax cuts pay for themselves?
No, the evidence is that tax cuts do not pay for themselves. And our model is that we're doing, our macroeconomic effects show that. You saw that in the Tax Relief Extension Act. But we're hoping the estimate's more centered now, that we're getting it in the right. The point estimate is being more accurate.
To get back to the financial markets uncertainty lately, not to be a pessimist, but we do have a Fed at the zero lower bound. We do have a historically high and growing amount of debt to GDP. What are the risks of these two conditions should there be a global recession, which is presumably not unthinkable given what we've been seeing in some of these markets?
Well, first, I'm not sure that these markets suggest anything about a global recession yet. And again, as long as the economic fundamentals remain unchanged, then this is not something that we should worry about. And I think from what I've seen from the Fed, they've made noises, too, that they're going to focus on economic fundamentals. And fluctuations in equity markets are not the same thing. Jumping to the issue of future downturns, that's one of the reasons why we're really concerned about the growing debt. Because as debt continues to grow, it handcuffs the government, if we go into another recession, about what they can do to policy-wise to work through it. We lose this sort of flexibility. And to give you some idea of how important that is, I'll repeat something that you all probably know, but keep in mind that debt to GDP ratio in 2007 was something like 38% of GDP. We're now up to 74% after the Great Recession. That's a huge change. And that's a difficult thing. And starting at 74% would be a difficult thing to do to deal with another downturn like that. Yes.
There was something in the changes about between this and March about reclassifying about $200 billion related, I think, to health care. And it wasn't quite clear from what I could read about. It looks like it was reclassified in March and then reclassified this time or something. Can you kind of walk us through what that had to do with? And it sounds like it's all technical, but just so we understand.
Right. Yeah. I mean, temptation is to think of it as a technical change, but the fact that it was in our forecast in March makes it a change that affected our estimate of revenues, but it didn't fall into the technical category.
So what was the original thing to come up with $200 billion, and then I guess what was the treatment in March versus the treatment now?
That I can't tell you. I don't know. I've had too many things to look at.
I was going to say it's a teeny tiny technical question. I didn't understand it.
I appreciate the question, but we can follow up if you like. So be so absolutely clear that we've left you with no questions?
Seems like there are not as many changes in this update as in a lot of the previous reports. It seems like minor changes.
Yeah. I don't have experience with previous reports, but certainly the economic change, the drop in the disappointing first quarter of growth had a bit of an impact, and even now it looks like since July 7th it's a little bit less of an impact than we thought because the data's looked a little bit better going forward. And then of course I guess the revenue rise, but other than that we really haven't changed our views on the potential of the GDP and the long-term view of the economy and the budget going forward. We really haven't changed that much. We've still got a tricky time because we're still looking at significant slack in the economy. We've got to the end of 2017, at least by our forecast, before that slack's gone, and until that goes, we don't anticipate that wage growth is going to be what we'd like it to be, what it should be, until that slack goes away. And I think that's going to be a challenge going forward, that we get sufficient economic growth and we get that slack out of the economy.
This may be outside your purview, but any thoughts on what kinds of policy changes could accelerate that growth and reduce the slack?
No, I wouldn't want to speculate on that. You know, and it's always a difficult thing to imagine what's going to spur the economy in the short run. Obviously, part of what we're dealing with right now is the fading of the automatic stabilizers that we already went through in the Great Recession. You know, the push in aggregate demand is now sort of faded from that. So that's a little bit obviously what we're dealing with, but you always deal with that in a recession. One of the things that I think that looks like a real almost unknown challenge right now is productivity is not growing like it usually does through a business cycle. And I think that's probably a real concern, not just in the United States, but around the world. Productivity growth is not very strong. And that's going to be a real key thing going forward. I think once we get rid of the labor market slack, is to start seeing some source of productivity growth to get us back to something like a long range. And it's actually part of our forecast that we're going to get a bounce back in productivity, but it's in some ways it's overdue right now.
Is it a subject of debate why productivity growth is weak?
It is. It is, and there's no real clear answer. And hopefully, when we see it bounce back, we'll figure out why it was so slow. But that's an important part of this forecast and anybody's forecast, is that productivity gets back to something like its usual range, long-term range of growth.
Would that have an impact on you guys' estimate of potential GDP if there's not that bounce back? And can you kind of walk us through on where that potential GDP has been to where it is now to where it could go, I guess, if there isn't this bounce back?
Sure. If something like potential GDP, it requires a number of things. You get back to sort of full use of your economic resources, right? So you get your labor force bouncing back and employment to bounce back. We've probably got some catch up in capital investment. In fact, part of our forecast is a little catch up in business investment. That's one of the things that we differ a little bit from some of the other forecasters. Is we're a little bit more bullish, I think, about a bounce back in investment. But you get labor force back and investment back, and then you hopefully get this productivity back, and that's sort of the recipe for economic growth going forward, getting the full employment. And you know, although we've had sort of this disconnect between productivity and wage growth a number of years ago, growth and productivity has resumed to sort of, it's now following labor compensation. I mean, they still are related. And we still expect that you're going to need growth and productivity to have strong growth in labor compensation. You know, and one of the things that it was waiting to happen too is the labor share of GDP right now is still low, and that needs to bounce back. And that's going to be part of this, getting rid of the labor market slack and increasing demand really for labor services. More questions?
We have one not completely unrelated, but you guys did do the Friday release of the economic analysis of Obama's budget. And one of the things that struck me in that was you talk about that GNP in general would be higher, but that per capita GNP would be lower, and because of the immigration aspect of the president's budget. And my layman's reading was sort of like, well, that means more workers and therefore lower wages, but I take it's not quite that simple. Is there a way to sort of walk through what that actually?
Well, certainly part of that is if immigrants are below average in their earnings, their wage, or their income, then if you increase immigration, even if you increase employment with immigration, because they're below average, you're going to sort of lower the per capita GDP. And that's going to be a challenge kind of going forward when we have this declining labor force to begin with, is We're obviously slowing our forecast for GDP growth in the future, and we've got the issue of the sort of the ratio of people working to not working in the economy as the population ages. So if you have slower GDP growth and you have still a large population, you're going to have maybe a slowdown in per capita GDP growth. But that's going to be something that a lot of economies are going to experience because of aging population, aging labor force.
Just to follow up on that, so the immigration proposal, assume that's passed, and you have low-wage workers, more low-wage workers in the country, so that would reduce the average wage, right?
Right.
It would reduce the average wage, but would it necessarily reduce other people's wages? I mean, middle and upper income wages. It could reduce the average wage, but does that also mean it would reduce the wages of some, I guess, existing workers who were working before the change in the law?
Yeah, our reading of the economic literature is that it doesn't, that it doesn't reduce other wages, and that's part of the forecast in the analysis of the President's budget. I hope I have that right. Other questions? Yeah. You've held up great, though. Thank you. Okay. Is there any reason to continue? Okay. Unless I could ask you questions now.
That could go a long time.
Yeah. Okay, well, thank you. Thank you for coming.